All right. Good morning, everybody. Thanks for joining us today. I'm John Raggozino with ICR. We've got a great topic today to discuss on the recent emergence of public market crypto balance sheet strategies. And before we get started, I want to just give a big thanks to the ICR events team for putting this together in a short time, the Clear Street team for all the help and the heavy lifting and marketing, obviously all the panelists who participated, and special thanks to the Exec Edge research team who put together the associated research report that came out earlier this week on the topic. It gives a great overview of the strategy, the pros and the cons, and all the players involved. If anyone has not seen that report, you can find it in the registration link of the invite, or you can reach out to me at john.raggozino@icrinc.com. So with that, I want to just a little bit about the format. We're going to try to keep it very conversational. I want to get each of the panelists a second to give a brief overview and intro of themselves and their company. And then we'll open it up for just high-level questions around the topic itself. And then at the last 15 minutes or so, we'll dive into some audience Q&A, if that works. So let me just introduce first, we've got Leah Wald, the CEO of Soul Strategies, Brian Rudick, the Chief Strategy Officer with UPXI, David Bailey, the founder and CEO of Nakamoto Holdings, and John D'Agostini, the co-head of investment banking at Clear Street. So Leah, do you want to give a brief intro?
Sure. John, thanks for having me. Everybody, it's great to be on a panel with everyone here. This is going to be great. Background as relates to today, I've been in Bitcoin asset management for about 9 years, previously with Lucid, one of the first specialized RIAs in allocating in GBTC and investing in Bitcoin, educational programs. After that, co-founded and ran a firm called Valkyrie Investments, and we launched some of the first crypto ETFs in the United States. And now I'm running Soul Strategies, previously Cypherpunk Holdings, and excited to be here today to talk about it.
Great. David?
Hi, everyone. I'm David Bailey. I'm wearing two hats right now. So I'm the CEO of a company called BTC Inc. that I've operated for the past 13 years. BTC Inc. owns the largest Bitcoin media company and the oldest Bitcoin media company in the world, Bitcoin Magazine. We have the largest Bitcoin conference in the world. We just held it in Vegas for 35,000 people. It's where the president and the vice president have spoken. And then UTXO Management, which is, I believe, the best performing hedge fund in the world. We were the 5th best performing hedge fund last year. And that's really how we stumbled into the Bitcoin treasury strategy. And so that culminated in us creating a new company where we're going to take the strategy to the next level. Called Nakamoto, and we just completed a $710 million financing. And then as of this morning, we announced an additional follow-on $51 million investment. So we call our strategy MicroStrategy Squared, and our goal is to bring a MicroStrategy-like equity entity to every capital market on the planet. And so you may know some of our portfolio companies we've already created, MetaPlanet, Smarter Web, some really incredible stories I hope to get into later on in this discussion, but very thankful to be here.
Thank you, and congrats on the deal today. That's exciting. Brian, you want to go ahead?
Yes. Hi, everybody, and thanks so much for having me. I'm Brian Rudick, the Chief Strategy Officer of UPXI. We are a leading Solana treasury company. My background, I spent a decade on Wall Street, mostly managing a book of bank stocks for funds like Citadel, Millennium, and Balyasny. It was really a couple of the banks that I covered that were the fiat on-off ramps for crypto, like Signature and Silvergate, where I went down the crypto rabbit hole, decided that this is the future and everything would eventually move this way. So wanted to get into crypto full time, joined GSR, where I led their research effort for the last 4.5 years. And GSR was the lead investor into UPXI. And then it just made a lot of sense for me to join them. UPXI, we have nearly 700,000 Solana. We think that we have a differentiated management team. Our founder, Alan, actually started XPO Logistics, which is a $15 billion NASDAQ listed company. We were backed by 15 of the most prestigious crypto venture capital firms. And then we try to do things the right way, which means that we won't take on too much leverage. We're not doing a lot of on-chain degen stuff. We only use qualified custodians. We diversify amongst them. And we think that this strategy will resonate with both crypto and traditional investors as well.
And last but not least, John.
Yeah, I guess I'm the one that's representing traditional finance here. So from our perspective, I I co-head investment banking at Clear Street. Clear Street, the parent co, is a fintech native company that was founded about 6-7 years ago. They have cloud native software that is refitting the capital markets infrastructure for most of clearing and prime brokerage out there in the space. Me and my co-founders co-founded the investment bank roughly 2 years ago. I spent most of my time in traditional finance, banking, financial or FIG for a bit. Then tech and crypto for me personally has been the perfect marriage between FIG and technology. And I'm extremely excited about the prospects that it has now that crypto and blockchain companies are able to come into traditional markets, and all the opportunities and capital that can help them grow and get to where they need to be. But I'm not the star of the show. The CEOs and CSOs here are, but happy to answer any questions on capital formation and strategy.
Excellent. Thanks so much, everybody. I want to start off really from a high level perspective around the evolution of the strategy and give a little bit of context. And I'm going to try to direct the questions at an individual participant, but feel free if anyone has something to add, certainly just jump in. It's a little bit less formal than that. So, let's say Brian and Leah, how do you think about the corporate strategy development from back in 2020? It was more of an experimental approach with MicroStrategy, and what we've seen today, there's kind of a evolution there. What type of specific factors have taken place more recently that has kind of set the stage for what we're seeing, in the last several months? There's been like an influx of this approach.
I can go first, Brian, if you want. Sure.
Great.
Well, I would actually take it back to 2018. And I'm going to shill the previous successors of Soul Strategies really quickly, but Cypherpunk Holdings was actually a MicroStrategy type vehicle in 2018. So it has been around. This, evolution of corporate treasury strategy has just been significant. So to your point, let's start with 2020, obviously MicroStrategy. So, we've seen this just significant shift in capital markets over the past 5 years, using 2020 as, the starting point. And as we all may remember, in 2020, allocations to Bitcoin were still considered very speculative, right? Limited to very visionary outliers. So the mass mutual buy made headlines, right? It was, but the most pivotal move really did come from Saylor, who didn't just buy Bitcoin, but he framed it as a long-term capital allocation strategy. And he had a clear thesis: scarcity, durability, and protection against monetary debasement. He talked about a lot. So I think Saylor's approach created that new public company category that we're talking about today. Call it the on-chain balance sheet digital asset operator, if you will, right? So that model, I think, paired with macro drivers like inflation fears and the low rates and eroding trust in fiat, I think catalyzed that first wave of institutional adoption, including COVID. By 2025, it looks very different, right? What had started as Bitcoin centric has definitely evolved into broader digital asset strategies, as you can see on the call today. No longer is it just holding assets, it's also engaging with blockchain native economics. So, and if that's outside, Bitcoin treasury specific. So at Soul Strategies, as an example, we built a version of that playbook, and a lot of other companies are starting to do something similar that's more akin to leveraging what's available on the tokenomics of each of those blockchains. So as an example, instead of just holding Sol, we're generating yield from it, right? By running validators, you can expand the treasury, directly participating in the architecture of the network, creating a flywheel. So it's very integrated. And I think that that's where we've gotten. So you said key inflection points. I think MicroStrategy's blueprint and Saylor specifically educating the public, 2020. In 2021, you had Tesla and Square, which I think validated that model. Later 2021, with Valkyrie, you also had the ETF approvals in the United States that I think de-risked that exposure. And then I think now you're seeing the institutionalization of staking. And you have firms like BlackRock with, BIDL coming on Solana Rails is something they've mentioned, Apollo as well. And I think that takes you to where you are today, where it's no longer just, experimental, but it's becoming a competitive advantage to start really thinking through the economics of each of the blockchains if you're going outside Bitcoin as a treasury strategy because of the opportunity for native yield.
I wanted really quick, Brian, before you start, if you could help us, I think it's important to set the stage around, defining what we've said in this report as core strategy companies versus the incidental allocators. Can you help us understand what the difference is and where you guys lie? Just so that the audience is clear on what we're focused on.
Of course. So in my mind, an incidental allocator is something like Tesla that actually wants to put a portion of its balance sheet to work and hold it in the form of a digital asset. And then those that look at this as a core strategy are actually the ones going out there and accessing the capital markets to try to actually buy more of the digital asset that they're underpinned by. So that, in my mind, is the key difference. And then the only thing that I would add to what Leah said is I think that there's two big reasons for the recent proliferation in digital asset treasury companies, in addition to what she said. So one is, I do think that there is a greater appreciation for all the value that companies like MicroStrategy have created. So it's been the best performing stock since it turned on its Bitcoin treasury strategy in August 2020. It's more than doubled the performance of Bitcoin, and it's not fully levered. So there has to be actually something behind it. And I think folks are actually coming to that realization that there actually is this capital markets arbitrage, if you will, behind it that does create a lot of value for shareholders. The second thing is the SEC is obviously much more open than it had been. And I think that is really important for us because if you actually are underpinned and have 40% of your balance sheet in what is deemed a security, you're an investment company under the 40 Act, and you're actually subject to heightened rules and restrictions and reporting requirements. And so with Solana being clearly a commodity and other companies having more comfort that tokens that they're underpinned by are likely deemed and viewed as commodities, I think that gives smaller companies more confidence to do this as well. So I think that has also contributed to this proliferation that we're seeing in digital asset treasury companies.
Thanks. David, I don't think anyone could argue that you're probably one of the original gangsters of Bitcoin. And so there would be an argument to be said, it could be said that, a lot of people argue for holding just a token versus why would you buy a treasury company? One would think that from your background, you might err towards the side of holding the token itself. Can you help us understand what the difference is? And then also what the benefits of actually owning a treasury company would be?
Yeah. So first off, to every person, I recommend that they need to hold their own private keys, and they should prioritize having self-sovereign control over their own money before buying Bitcoin treasury companies. Bitcoin treasury companies are operating companies. They're a financial arbitrage play. And fundamentally, why you buy them is because you think that they're going to give you some amount of leverage on Bitcoin that's going to outperform Bitcoin. And I think so far the track record has demonstrated that. We've had some pretty crazy successes so far with this strategy internationally. I think MetaPlanet is probably the poster child of what can be possible here by accessing cheap credit or accessing the capital markets. And so, we underwrote that business at a $15 million market cap roughly a year ago and 2 months. And today they're sitting at like a $7 billion market cap with the price of Bitcoin only doubling over that period of time. So the Bitcoin treasury companies are driving a lot of outperformance on Bitcoin. And I think, the only way to outperform Bitcoin is by taking on more risk. So there are more risk in these entities, but risk should be a part of every portfolio. So I think, you should own your own private keys and you should own some Bitcoin treasury companies.
That's very helpful. John, can you just help us understand the actual mechanics and the utilization of the public capital markets into these vehicles? Just kind of set the framework, and then if each one of you could kind of run through high-level thoughts on your individual cap stack and what the future might look like in terms of public capital raises.
For sure. Yeah, I think from the capital markets perspective right now, a lot of focus for traditional strategy companies has been placed on what is calculated as the MNAV, or effectively what you're selling equity at versus the spot price of whatever asset you're buying, whether it be SOL or BTC. So a lot of the equity investors that are coming into these constructs are either buying it because they're getting a cheaper exposure to the underlying asset, or there's a great narrative associated with it, or both. I think right out the gate, the three folks that are on the call with me here, they have a pretty clear plan of what they're trying to do on their accumulation strategy. So the equity story is pretty easy to understand, and then it becomes a little bit of financial engineering and arbitrage that occurs when you start to mix in converts. And recently, Michael Saylor with his preferreds, they all hold a piece of the cap stack long term. They're all sold to different types of investors with different risk tolerances. And from the treasury company's perspective, should all be a part of their capital formation and their thought process around which levers to pull. There's also the ability to have ATMs both on your equity and your prefs, which give you access to capital depending on where your equity is trading or your converts are trading at any given point. And everything is backed by the underlying asset, which makes it extremely attractive to get some leverage on the equity here.
That's helpful. David, given like the transaction that you just completed last night, I guess, why don't you go first and just give us a high level overview of your views on the capital markets and what your strategy is?
Well, first off, I'm a Bitcoin native person. I have, limited public markets experience, 2 years of public markets experience now. And so it's been very eye-opening to go from, as a Bitcoin operator, we've had our bank account shut down 3 times and we probably could never qualify for a loan, to, being able to secure a $200 million convert overnight. It's pretty incredible what the capital market gives you access to. We raised $510 million in common equity at $1.12. Then we raised a $200 million convert at $2.80. And then we just raised $51.5 million at $5 a share of common equity. So the goal is to just keep raising the floor of what you're able to raise at and raise as much capital as possible to deploy into Bitcoin. I think, in terms of the general strategy, I'm going to say Michael Saylor is running the 180 IQ strategy. I think what he's done with Strike, Strife, and Stride are extremely impressive. And I think that each of those different pref structures are going to be replicated in every capital market globally. So I think this is kind of a algae bloom that's occurring here. In terms of the strategy that we're deploying, we're focused on what I call the 60 IQ strategy, which is just focused on the MicroStrategy type equity structure and replicating each of these markets. And what I've been blown away by, and I think something that's very underappreciated, is how much capital is stuck in each of these markets and how many players are limited to their domestic playground. Even if you have access to the Japanese market, I mean, if you like today, retail drives a lot of the activity of what's happening around these stocks. My dad may technically be able to buy a Japanese stock. He'd have no idea how to do it. So I think that's replicated in each of these markets. If I look at the shareholder base of MetaPlanet, it is dominated by Japanese retail and Japanese institutions. If I look at the capital at the shareholders of Smarter Web, which is now our latest and greatest success story, the most successful IPO. Somebody told me this yesterday. The most successful IPO in 400 years of capital markets history in the United Kingdom. It's dominated by British investors. If you go to each of these public companies internationally, they're like the hometown heroes of their local capital markets, and they're able to tap into the index funds, the pension funds, the mutual funds, the retail base for each of their different markets that, for whatever reason, either can't or won't buy MicroStrategy. So I think there's just a massive opportunity to go and replicate these vehicles and sponge up as much capital as possible to redeploy into Bitcoin.
That's really helpful. Leah, do you want to give a brief overview on you guys' approach?
Yeah, sure. A little bit different only because, and I should say, David, congratulations again. That's massive. I think that there's a different approach to be taken when you are working in a proof of stake network and therefore can, again, as mentioned, utilize those economics. So for us, there's 2 parts to it. We are first and foremost a technology company. So we're running a very large staking business. So we're not just a treasury management or a treasury company, but really looking to grow that validator business that we already have. So our accumulation strategy is specifically to feed back into our validator business. So the more SOL that we accumulate, the more that we can stake to our validators. We have immense yield on the validator side. We make money from the commission side of running the validators. So it's a little bit more nuanced in that way. Now, we also have raised very large facilities to pull down on, but we're also trying to be a bit strategic on ensuring that it's timed correctly. And we have a lot of corporate developments these days as well. So just trying to roadmap it. But again, the difference is just taking advantage of the opportunities to stake natively and therefore build our business, which is really the core function. And, capital accumulation is a piece of that core function.
Thanks. And I know that you guys just put out the 40F filing, so looking forward to seeing you on the NASDAQ shortly. I don't need any more specifics on timing, but I wouldn't expect that to take too long. So exciting things to come. Brian, how about you?
Yeah, so our strategy is to acquire and HODL as much SOL as possible, and we will only do this when it is accretive for shareholders, and we'll do it in a risk-prudent fashion to ensure that we can be here in any market environment. And really the thing that gets me so excited is for all these digital asset treasury companies, and specifically when you're underpinned by a proof-of-stake network like Solana, there really are all these multiple value accrual mechanisms that compound. So like Leah is doing, we are staking our treasury, so we're turning it into this productive asset. We're buying locked tokens at a discount, so this provides for built-in gains for shareholders. Roughly 60% of our SOL was purchased locked. And then also too, we plan to access the capital markets, where I really think much of this magic actually comes from. You can actually get into this capital markets flywheel, where the market will ascribe you this premium valuation or MNAV. Then you can utilize that for the benefit of shareholders by either issuing equity or issuing converts above book, which again is by definition accretive. And then you pull that in and you will increase your Bitcoin or SOL per share. And then that supports your share price and your multiple. And that flywheel just can continue. And so we intend to engage in that, hopefully in a big way, very soon.
Let's take a bit of a step back. David, can you just briefly explain the difference between a proof of work and maybe Leah, you can provide a little bit of a background on what a proof of stake network is, and then we'll move on to token selection and why one or the other is more suitable for the strategy. Go ahead, David.
I might have a controversial take on this, and so maybe
that's why I asked you.
Proof of work and proof of stake are both consensus mechanisms that fundamentally are what secure the network and provide the trustlessness and permissionlessness of the network. With Bitcoin and proof of work, at its essence, this is what the Bitcoin mining network is. If any of the listeners have heard of Bitcoin mining. And what you're doing is you're using energy in order to solve proofs that cannot be falsified and are just mathematical puzzles, effectively, to secure the network. And it actually requires a huge amount of energy in order to run this network. I think I heard a statistic that we're roughly 2% of the United States energy supply goes towards proof of work Bitcoin mining. So versus proof of stake, where proof of stake works much more like an equity-like structure, where your stake in the network is based on your role in determining consensus is based on what stake you have of the underlying asset. As a Bitcoiner and as some might call me a Bitcoin maxi, I would take the view that proof of work is much more commodity-like, whereas proof of stake is much more security-like. So that's my personal take.
Thanks, Leah. Can you explain what the proof of stake does and why have you selected Solana over Bitcoin? Just so I want to make sure that there's a clear distinction.
Well, the Bitcoin maxi is going to come out right now as well. Because I do think it's important. At the end of the day, I think that people like David have been successful, has changed the world because the world sees Bitcoin as different. I think that there's a greater understanding that Bitcoin is a real store of value asset. Larry Fink talks about it. In the earlier days, David, as you remember, Washington Post was calling us terrorists every day, right? And that was it. And there was
They still do.
Terrorists and drug dealers.
to be clear, I know we're on an ICR webcast, but I'm going to be honest here. And it was a very different time where there was no differentiation between the different tokens, communities, and what everyone was trying to do. And it was extremely important to ensure that everyone understood the value and the beauty of Bitcoin back in those days. Now, I see Solana as very different, and I love both at the moment. Bitcoin still has my heart as a store of value asset, all its different beautiful pillars and principles. Why I'm interested in Solana for Sol Strategies is that I see it as an incredible platform that has superior advantages over Ethereum and is the platform that can actually take capital markets to the next level as a base layer. So as we've mentioned, we're trying to be the first public company ever to tokenize our stock and tokenize it on Solana specifically. So due to its pillars of, sub-zero finality, how quick, how cheap, how efficient, I'm excited by the developer community and just what can be built on top of it. So I am really interested in both. I didn't answer your question about proof of stake there. Proof of stake, obviously, being to David's point, an ability to change the dynamics and economics of a blockchain by securing it on a validator whereby investors who have staked to that validator are accruing yield, and the validator operators are also given a reward similar but different to mining stocks. But again, that's where I see the differences, why we're interested in Solana. We think it's an incredible blockchain and that there's a place in the world for Bitcoin and Solana to win in their respective beautiful ways.
Yeah, I'll just jump in there and maybe tie the two together. So we think of Bitcoin as the best monetary asset and then Solana as the best high performance blockchain. And so for us, we could have actually come out and done something on Bitcoin. I think that there are a lot of companies doing things with Bitcoin, and like Bitcoin has the most recognition by far, but we didn't have anything that would be particularly innovative for us there. And so obviously there's fewer doing this on Solana. And then the second thing is Bitcoin is a $2 trillion asset already. It is the best monetary asset and store of value out there, but Solana is just 4% of the market cap of Bitcoin. And so for us, it is within the realm of possibilities that Solana 5X's by the end of the year. And so all else equal, one could argue that there is more upside there. And then I just plus one to everything that Leah said, like we chose Solana out of all the high performance blockchains because we do think it is the leading one and has the best chance to be the end game winner. It is putting up a lot of metrics that are on par or better than other chains, even at a smaller market cap than some like ETH. And then it does have this large and vibrant ecosystem of users, developers, and dApps. So for us to be underpinned by Solana within the realm of smart contract blockchains just was a very easy decision for us to make.
Thanks very much. Leah, you touched on it a little bit earlier, but can you help us clearly distinguish between those with a passive holding strategy, which some of the competitors out there now don't have any underlying other businesses, versus a active staking or validator business such as yourselves? And what are the key differences in terms of like the return profile? How do you think about the risk profile? Just help us understand the key differences there.
Yeah, I'll speak to Sol Strategies, and then, I think David and Brian can speak to the other side. Again, I think that there's a difference to note that we're not just earning staking yield from our own Sol, but again, because we're running a large validator business and we have 3.6 million Sol staked to our validators, over 5,000 unique wallets, it's actually pumping into the core business as well. So yes, there's a huge difference. I think that there's a lot of financial and capital market engineering that can be done on a pure Bitcoin treasury, or any other treasury company. But for us as a technology company, first and foremost, it is important that we continue to accumulate Sol as much as possible, albeit strategically, because again, it does build our core business. Increase revenues, again, not just from that staking of our own Sol side, but also to increase the economics and revenue from our validator operation side as well. So a tiny bit nuanced for our case, given, the business that we run, but yes, by, getting more SOL, by accumulating more SOL on good terms, both the business and our balance sheet increase given the accrual in kind of the asset.
David, do you want to outline the core outline of how the passive strategy works?
Yeah, the passive strategy is to follow Michael Saylor and just buy Bitcoin and hold it. And because Bitcoin has that absolute finite supply, the more companies that are buying and holding Bitcoin, they're cornering the market on Bitcoin. I think 800,000 Bitcoins today are held by corporate entities. I think in the not so distant future, you'll have 1,000 plus public companies out there buying Bitcoin every week in the markets, and you can kind of run a financial model of how much Bitcoin that is and what would be the impact to the market capitalization of Bitcoin if 1 or 2 million Bitcoins were taken down. I would push back a little bit in the sense that our strategy is not a passive strategy. In fact, we are categorizing our Bitcoin on our balance sheet as inventory. We're utilizing that inventory in a host of different ways. First off, we're rewrapping and repackaging our Bitcoin into different capital markets, into different equity structures, and eventually pref structures, where we're utilizing that Bitcoin actively as part of a capital strategy globally. And so we're going to be deploying 20% plus of our balance sheet and our Bitcoin into other Bitcoin treasury companies. There's a lot you can do with Bitcoin. So there's you can sell covered calls, you can have a robust balance sheet strategy, and I think that's part of where this market is going. There's a lot of value to unlock by putting your balance sheet to work. And I think, that Saylor's left a lot of money on the table by not doing so. I do think you have to weigh the risk reward profile of these different strategies. Is it worth, rule number one is don't lose your Bitcoin. So is it worth risking your balance sheet for 5% or 6% returns? And I think that's a very fair critique to have. We found the happy medium is just rewrapping our Bitcoin into other balance sheets, and then we have the upside, but we also have the governance control of the Bitcoin. We're never really losing control of where the Bitcoin is going. Whereas with smart contract platforms, there's just a lot of risk. There's a lot of opportunity, but there's a lot of risk. So it's all about just making the right risk reward trade-offs. And I think from Saylor's perspective, the price of Bitcoin is going to $50 million of Bitcoin. It's going to $100 million of Bitcoin. And so why does it matter to go squeeze out that extra 5%? Just hold the Bitcoin, don't lose the Bitcoin, and keep accumulating it.
I like the simplicity. You touched on a really interesting element of which we haven't seen a whole lot of yet, but the diversification strategies that have tied the crypto treasury strategies to some of the crypto native businesses. Are there any other ways you can see a treasury strategy combined with an underlying business that can provide significant synergies that really haven't been explored yet, or just theoretically, what might make the most sense beyond just balance sheet management, liquidity services, that kind of stuff?
So first off, I think every public company is going to own Bitcoin eventually on its balance sheet, and so there is a massive market to service that all needs a similar set of services, products, and services in order to do so. Part of what we're wanting to do at Nakamoto is actually acquire a portfolio of operating companies that can service the public markets. And so we have a call option that we may or may not execute in the future to acquire BTC Inc., my other company, where we're thinking about these public companies in each of these international markets as distribution points in order to sell products and services into those local markets. So for example, BTC Inc. has a partnership with MetaPlanet where they operate Bitcoin Magazine Japan. We just did a deal for Bitcoin Magazine Portuguese. Each of these different markets has a massive base of Bitcoiners and community built around them. We're also looking at custody products. We're looking at brokerage products. We own a company in Canada, LQWD, that does Lightning provisioning, where they provide Bitcoin as liquidity into the Lightning network, which facilitates payments. So, I could imagine probably 10 or 15 different businesses that you would want to have a balance sheet of Bitcoin in order to facilitate executing. Lending is another one. So, looking at this as the formation of a new global Bitcoin denominated monetary and financial system. And so we're going to rebuild every financial services product that exists on top of a Bitcoin native stack. And so we're looking for those opportunities. I mean, I something that we talk about often is, you know, we're working with a lot of governments now who are wanting to also accumulate and hold Bitcoin. And so, you know, one thing that governments love is they love debt. They want to issue debt against their Bitcoin. They want to get the lowest interest rate possible. And so this concept is called a bit bond. And we see a world where, you know, people who hold large amounts of Bitcoin are going to be able to be the financiers of the future for government finances. So I think we're really just like at the beginning of this much broader view of how to use Bitcoin in the capital markets. That's a long answer. I'm sorry.
No, that's very helpful and very exciting times. I want to shift gears a little bit and just kind of take a look from the risk perspective. John, this one's for you. You know, obviously everyone understands crypto is incredibly volatile. What are some of the key risk mitigation strategies that are employed when holding this type of strategy on the balance sheet? And then where do the public capital markets and traditional, you know, institutions such as Clearstreet, where do they play in that role?
Yeah, I'd say on if anybody buys a treasury company, any institutional or retail client, they should understand the risks and the volatility that's underlying any asset that they get involved in here. We play on a whole host of different fronts here, obviously with convertible bonds and facilitating convertible arbitrage strategies on behalf of our clients, as well as on the derivative side and the options market. People are hedging all the time. It's part of doing convertible bond math that you get your hedge on. And the reason why convertible ARB funds love this product is because it's a way to pick up cheap vol and be able to short. I would say how it goes and plays out moving forward is yet to be seen. I happen to be bullish on the entire treasury accumulation strategy, kind of like David, in the sense that I think we're in inning 1 or 2 of this, and how it plays out from a narrative perspective will really shape the future of M&A, of how Fortune 500 companies look at having these assets on their balance sheet. And I think that the companies that can form in the future based off of a starting point of being a treasury strategy is going to be pretty incredible for what crypto can do and how fast that it can do it for these companies. It's moving money like never before, and we're in the early innings of AI, and there's no AI with crypto, in my opinion.
Can I jump in as well? I think, you know, at the end of the day, each of these treasury companies, they're beta on the underlying asset that they're accumulating. And so as long as the Bitcoin market is appreciating, Bitcoin's appreciating, I think that these are going to continue to outperform Bitcoin. And when Bitcoin is underperforming and going down, they're gonna underperform Bitcoin. Mm-hmm. And so I think we're in the early stages of what is going to be a historic Bitcoin bull run. I think that Bitcoin is going to $200,000 to $300,000 of Bitcoin and beyond. And so that's going to do a lot of heavy lifting for all of these treasury companies as they ride on that wave of liquidity that comes from that. And, you know, what's interesting about this, and Leah, you mentioned this earlier that you were involved in GBTC. So was I, and I feel like there's a lot of interesting parallels between GBTC and treasury companies. But there's one distinct, very important difference between the two. GBTC was a closed-end trust, which meant that when they started trading at a discount to NAV, everyone was screwed. It was like, okay, the only out was to get the ETF approved. These are operating companies. And so these companies are able to buy their shares back. And so at the end of the day, our mandate as operators is to increase the underlying asset per share. And so that means when we're trading at a premium to NAV, we're selling shares on the primary or on secondary, and we're taking those proceeds and buying the asset. It works the other direction too. If we're trading at a discount to NAV, which I imagine many of these vehicles will trade at a discount to NAV when we enter into a bear market for Bitcoin, we can buy our shares back, and it's like we're buying a Bitcoin for less than a Bitcoin. So we're either selling a Bitcoin for more than a Bitcoin, or we're buying a Bitcoin for less than a Bitcoin. And so either direction, there's actually a financial arbitrage that can happen that's extremely accretive to shareholders. So we haven't seen that part play out. And I think there's each of these treasury companies needs to be developing their game plan for how they're going to make money for shareholders in the down market. But there's just as much money to be made in the down market as there is to be made in the up market.
Now, that's a really important distinction, because in theory, you shouldn't really ever see them go too far below NAV, because you should be out immediately buying shares back and supporting the price.
And
Go ahead, Leah.
If I could just add to it, David's absolutely right. And yes, GBTC was a very funky structure, closed-end fund that didn't allow for redemption. So it created this, earlier precedent that no longer exists. David's absolutely right. And what is interesting and does have historical precedent is that Bitcoin mining stocks have always been traditionally that overperforming, underperforming to spot Bitcoin, and played as such and played as leverage. So I think that was the original development. And I do think that these treasury companies that are coming out with such great management behind them will be the next iteration of that. I definitely agree with what David's saying.
The other thing that I would add, if I could just very briefly, is I kind of think the strategy is just on pause during the inevitable crypto winter. And what I mean by that is, like, if you look at Bitcoin per share and MicroStrategy, last year they increased it 74%, 2021 they increased it something like 50%, and then the 2 years in between during the crypto winter, they still increased it, but only like mid-single digits. So in my mind, the strategy is just a bit more on pause. It's less powerful then, but then you will get into this inevitable crypto boom period, which I actually think that we could be on the precipice of. And this is because the biggest thing in my mind always holding us back is unclear rules and regulations in the US. I think we will get market structure legislation next year, and that will cause institutions to come in a big way. It's a little bit antithetical to crypto, but what I'd say is, like, if you could picture Google coming in, adding like a built-in wallet to Chrome, and you can picture like Amazon actually accepting USDC, we literally have the chance to onboard the masses, and digital assets, Bitcoin and Solana are going to be big beneficiaries. And then by default of that, digital asset treasury companies that are underpinned by leading assets like Bitcoin and Solana.
One last thing, John, don't kill me. I just love what everybody's saying. I think one important point here, given your audience, is the importance of looking at the blockchain thematic ETFs as well. You have billions of dollars. I believe ARK is holding 7.8 billion in thematic blockchain ETFs. I know that Block is around 1 billion, et cetera. If they start holding multiple treasury public companies, vehicle public companies, that is creating a different dynamic that could be very positive, as again, they need to, yes, rebalance, but it actually may increase share price and be a different hedge against any price drops in underlying spot, as again, these are ETF accumulation, blockchain vehicles that require equities rather than being able to buy spot.
I just want to do one quick. I got to remind everybody, we're a few minutes out from Q&A. So for everybody that's on the webinar, you do have the ability to hit the little widget at the right of your screen to submit a question, and we can get in there in a moment. But go ahead. I'm sorry, David. Continue.
Yeah, so this will be my final comment on this. And so, we're doing round robin here. But I do think that something that is important to hit on as we're talking risks and we're talking, as investors are listening to this, not all blockchains are made the same. And I do think that one of the big risks, and something that everyone needs to be aware of as we move up the risk curve, is that while I think this strategy can work for Ethereum and it can work for Solana because there's very large user bases of those blockchains and there's real demand, what you don't want to do is you don't want to buy a treasury company where the treasury company is the only buyer of the asset, which I think once you get outside of the top 5 cryptos, that's basically what's happening. And so, the reason why in a bear market, we're going to be able to arb a discount to NAV and make money for shareholders is because ultimately we can sell our Bitcoin if needed. Not that we want to, but if we needed to, we could sell our Bitcoin, raise proceeds and buy our shares back. And that would increase the Bitcoin per share for our shareholders. If you're the only buyer of an asset, there's no one to sell the asset to. You can't get out. And so if you're short trading at a discount to NAV, you may be stuck at a discount to NAV. You may be stuck at frankly, it could go to zero. So, I mean, it's like you want to make sure that you're only buying treasury companies that are buying real assets that have long-term viability and have real user bases. And I feel like that's, in a bull market, it's easy to underappreciate that. But I think it's going to rear its head in a really big way in a bear market. And so just make sure you have long-term confidence in the underlying asset.
That's a perfect segue to our first question, because we're right about time where the audience Q&A, we're going to run through some of that. So the first one actually is directly related. So does anyone predict a significant stock buying opportunity when crypto prices cyclically crash by 50 to 90%? David, why don't you just reiterate the point?
Yeah, and I mean, we made good money on GBTC, arbing the 30% premium to NAV it was trading at. We made more money buying GBTC at a 50% discount to NAV and riding that all the way back up. So there's absolutely going to be huge opportunities. One man's misfortune is another man's fortune. And so you just need to have good capital allocators. You need to have good risk controls, and you need to have a strategy going in of how you're going to take advantage of whatever market environment you're in.
Great. The second question is for Brian and Leah. Can you guys discuss the sole advantages, volumes, and staking against the supply advantages of Bitcoin? Just lost my question because another chat came in. Against the supply advantages that Bitcoin has, and how important is SOL price inflation?
Go for it, Brian. I talk too much.
Yeah, so I actually think there are some additional innovations that when you're working with a proof of stake blockchain in a digital asset treasury company, you can actually employ. And so these are things like just what I mentioned, staking your treasury to turn it into this productive asset, buying lock SOL at this discount. And so I think that is the big advantage there. As far as Bitcoin's fixed supply, obviously it turns it into this premier monetary asset. And I actually look at these as two very distinct things. And so I think of Bitcoin as the best monetary asset, and then Solana being this high performance blockchain really is for this different use case and purpose. And so really, when you think about it, a smart contract blockchain, its TAM is actually global compute. And so Solana is actually trying to beat NASDAQ on chain, really targeting finance at first, but really anything that needs any sort of compute power, Solana can potentially end up doing. And so I just think it's like very different things that folks are looking at and going after different markets.
Okay. David, this one's for you. What other jurisdictions is Nakamoto actively looking at right now?
So, people think I'm exaggerating when I say we want to acquire 80 public companies in 80 different capital markets. I'm not exaggerating. That is truly our intention, and we are trying to pace to buy as many of these things as possible and launch them as quickly as possible. I think the markets we're most excited about that are in our pipeline: South Korea, South Africa, Saudi Arabia, UAE, Brazil, Germany, the Netherlands. I mean, I could go down. I could keep going. We literally, we have so many deals coming. We actually just committed to fund a deal in West Africa, in Ghana, which I think we're going to be probably the number one stock in Ghana very quickly. So, I think our goal is to just package Bitcoin so that every investor everywhere in the world who has a brokerage account is one click away from indirect exposure to Bitcoin. And we want to siphon as much passive flows from the global capital markets as possible into the Bitcoin capital markets.
Well said. Okay. I guess this one's also for you. Why do you think Metaplanet has seen so much more success relative to some of the other treasury companies?
I think at the end of the day, the number one driver of the success of treasury companies is execution. I think the market matters a lot. The question is, why has it been so much more successful? Actually, Smarter Web in the UK has by percentage return been even more successful. I think the commonality between the two is that they're both in capital markets that have a lot of restrictions. They're both in large, robust capital markets. And they both have great executors at the helm. And I think, there's a very unique story happening in Japan where there's a tax arbitrage opportunity. I think there's a 55% tax on digital assets. There's a 20% tax on equities. And so if I take my digital asset and I wrap it into an equity, I just saved a lot of money. And then likewise in the United Kingdom, they have certain types of retirement accounts. I forget the name. They're all these generic. Many countries have them, where you have to play in a certain basket of domestic equities, and so people are not able to buy MicroStrategy through those vehicles, and they're buying their hometown hero, Smarter Web. So I think it's the unique elements of the capital market. I think it's the low cost of capital, and I think it's the size of the capital market, and then the great execution.
The next question is about a comparison to gold ETFs when they first came onto the scene. They said they hadn't experienced a bear market in the first 10 years, despite the global financial crisis of 2008. It was more of a slowdown in growth. And then the core question is the bear market likely? How about Brian?
I will pass this to Leah if she doesn't mind. She's the expert.
Well, actually, I'll say my take,
Leah.
and then probably JD as well. And kudos to, I mean, I could talk forever about the innovation of the gold ETFs and say, kudos to Jan, but I promise I'll keep it short. It's a really interesting question, and that's right. The gold ETFs, their early years did coincide with that macro environment that did support its thesis. So debasement fears, low rates, geopolitical risk, and then yes, even the 2008 crisis did again reinforce gold's role as a safe haven. So it didn't trigger a true bear market, just a slowdown. So even though, digital assets, the dynamics are definitely different. And as we know, they're maturing, but also more volatile. And they do seem to be, especially, with macro events and news events, you'll see it very clearly, but driven by the macro trends. And then also tech adoption cycles. I know that JD, you had just mentioned AI. So I know we're all watching that. So as we all know, a bear market's always possible, and especially as the space reprices risk and rotates narratives, which is something that I think we're going to keep seeing. But as we all just mentioned, I mean, structurally, we're just seeing more resilience with the ETF flows and institutional participation across the spectrum. If you look at who holds the three of our public companies, it's from Invesco to other allocators. We have, family offices, you have crazy retail. So it's a lot of different participation. And then as Brian mentioned, also just clearer regulations. So I think that's providing much stronger footing that's been in the past cycles. So volatility is going to persist, but digital assets are definitely behaving like a new macro asset class, not just a speculative trade, I believe. So I think that, it's going to be a different dynamic and maybe less concerning.
JD, anything to add?
Yeah, I would just say Leah hit the nail on the head here. I think gold is forever been viewed as a stable store of value, and I think as Bitcoin and other digital assets go through more of these cycles, volatility will drop. People will start to adopt it as an inflation hedge, and my long-term view is the asset class. I think the bear markets will be less deep.
Okay, the next question is for Leah and Brian. How do you view the MNAV and the proper MNAV for Sol versus Bitcoin, and how do Sol treasury companies differentiate and earn a higher premium to their peers?
I'll leave that for you, Brian.
So in my view, when you get to a smaller company, you should trade at a higher premium. And that is because there should be this embedded growth premium. And so if you think about it, if we were able, we meaning UPXI, able to raise $100 million at 4 times, and we're trading at 4.5 times right now, that would be 50% accretive versus something like MicroStrategy. If they raised $100 million at any multiple, it really wouldn't do anything because they're so big. And so this is why they have to raise more and more money to be able to continue to increase that Bitcoin per share in a rapid fashion. And so as you're smaller, you should get this embedded growth premium. The second thing is, all else equal, when you're underpinned by a smaller token, in theory, there could be more upside. And so I think for those reasons, what you're seeing in the market in general is companies like UPXI and Soul Strategies and some of our peers tend to trade at higher multiples than those underpinned by Bitcoin. The second comment on MNAV is you really can't look at it in isolation. So if there's two companies that are based off of the same token, and one was trading at 2 times, one was trading at 8 times, I'm not sure which one I'd rather buy. It kind of depends what you think will happen in the future. If one's trading at 2 times and you think that will move up and the one at 8 times will move down, of course you want the one trading at a cheaper multiple. But if they're not going to change, you actually probably want the one at this higher multiple, because when they actually do go out and access the capital markets at 8 times, it's much more accretive. So I think it's not quite as simple as saying like, I want the one that looks cheaper or more expensive. But if you can trade at this premium multiple and you can stay there, you can really utilize and leverage that for the benefit of your shareholders.
That's an important point. Appreciate it. JD, what are some of the profiles for the institutional investors that are involved in this space? You're on mute.
Yeah, just went off mute there. Apologies. So the crypto native hedge funds, as well as we'll call it whales that are out there, have really stepped up and come into the TradFi market, which has been great to see. They're kind of leading projects and treasury companies that they want to back. On top of that, there's been multi-managers, hedge funds, convert arb funds that are starting to really take notice of this trade, and have come into several of the treasury deals that are out there, as well as market makers. I think it's only a matter of time before some of the larger long onlys are really starting to move into the space and really getting behind some of the projects and treasury companies that are out there. Yep.
If I can just piggyback on that, I would say that, this is probably one of the places that Bitcoin separates itself from all of the other digital assets out there, is that there's just a huge network of investors into Bitcoin and champions for Bitcoin inside of large institutions. And so, I think one of the most active investors in the space that's long only is Capital Group. Mark Casey at Capital Group, that they have a 5 to 10% stake in MicroStrategy. They have a 6% stake in MetaPlanet. And so I think you are seeing, Fortress get involved in some of these transactions as well. And so, and these are all companies that are chaired or led by people who truly believe in the underlying Bitcoin thesis. I think the bellwether investors that are coming, a lot of them are looking for arbitrage opportunities. And then I think the next frontier of who we've been talking to and engaging with is sovereign wealth funds. And I think the sovereign wealth funds have taken note of this strategy in general. And we talked to 2 this week. So I think sovereign wealth funds will start deploying into size. And I think from their perspective, there seems to be just a much higher degree of confidence in Bitcoin and Bitcoin's underlying value proposition for these larger institutional investors.
That's a perfect segue into one of the last questions we've got, is how large can the total market cap of all the Bitcoin treasury and Bitcoin or crypto treasury companies grow to in the U.S.? Strategies at 105 billion. Can the combined total grow to over $1 trillion? I guess the question is more, is there any cap or anything that you could see preventing us from further growth?
I mean, I'll just hit this one. Bitcoin's going to $1 million of Bitcoin at least. And so that's going to give you a $20 trillion market cap for Bitcoin. So the real question is, what percentage of all Bitcoin can public companies accumulate? And I think, 5% is where we're already at. I think 10%, 20% is very feasible. And so, yeah, I think we're going beyond $1 trillion of market cap across these Bitcoin treasury companies. I think we're going to multiple trillion.
No bias at all. Love it. All right, the next one is, let's see. How about, Leah or Brian, what's your vision for other equities and other assets traded on Solana?
Do you want to take this,
Leah,
Brian?
yeah, Leah, why don't you take that one given the Super Stake announcement?
Yeah, absolutely. Yeah, you've already seen a lot of funds that have started, being on Solana rails, Apollo being a notable one, BlackRock having announced that they also want to create a second BUIDL fund on Solana rails. There's been a lot done. Franklin Templeton as well has already had an on-chain fund on Solana for a long time. But in regards to equities, obviously, we're very excited. So we announced, thank you, John, a partnership with Superstate to be the first public company to tokenize our common shares on Solana. And I think that's absolutely the future of finance. So we're very excited about this. That, in the same way that technology and electronic trading completely disrupted traditional finance, we think it's the same with tokenized stocks. And here's the key difference that everybody needs to pay attention to. Not a derivative, a lot are derivatives, but actual common shares with the same voting rights and participation should be tokenized and traded 24/7. Why not? It's absolutely logical. We've seen it in crypto. I think it would be fascinating to see all of our stocks trading over the weekend when something interesting happens in crypto. I think that there's a lot of participants that would be interested in that. And especially if these stocks can actually participate in DeFi protocols. Therefore, going back to maybe a greater selfish reason at our company with our validator business as well. But yeah, I think that this is the future. I think tokenized equities are coming. Ever since we announced, you see BlackRock, you see Coinbase, you see Kraken, you see some of the top players all going to the SEC and having very productive conversations, as well as blueprints having been created by Lowenstein, the law firm, as well as Solana Foundation. So it's definitely coming, and it's going to be the most disruptive, thing to come to TradFi since electronic trading, I think.
I know we've got a couple of you have a hard stop, so if you need to jump off, for sure. For those of you that can stick around, I've got one last question around the horn. So I know Leah and John, you guys have something at 12, so I appreciate you sticking around with us. Thank you so much for participating. This has been a lot of fun. It's been really, really helpful and informative. If you can stick around, I want to hear year-end 25 and then year-end 30 price targets for Bitcoin and Solana, respectively.
Well, I mean, I want to stay for that, but I got to jump too. So thank you for having me on. Thank you, John.
We already heard yours. $20 trillion market cap. Thanks so much, everybody, for having us. And thanks, everybody who tuned in. We will distribute a replay of this. Have a great weekend. Thanks.
Thank you.
Thank you, everybody.
Thank you.